Well, let's turn back to markets and bring in Pierre Ouimet, head investment strategist at UBS Canada, for some context on what's going on that front. Pierre, we did see some gains on North American markets this afternoon or today in Canada. We did see the TSX sort of leading the way there among North American markets, but it seemed as though there was messaging coming from Fed officials out of the U.S. today that perhaps they've done enough with raising their interest rate hikes, that interest rates are high enough at this point. Not necessarily that they're done in their inflation fight, but that interest rates have gone high enough. What did you make of that messaging?
Yeah, well, first of all, good afternoon, Jacqueline. Nice to talk to you.
You too.
Yeah, I think the Federal Reserve is... they're kind of sending the message across that, it's maybe it's about time that we stop hiking rates. I mean, I think that's appropriate. They've done a lot of hiking over the last 18 months. And I think it's wise that they should step back a little bit. And, I think they realize also that the U.S. economy is not really running on all engines right now. It's basically government spending and the remnants of the pandemic savings, which are slowly being wound down. So, I mean, I think they can read the tea leaves and realize the economy in the U.S. is probably headed for a few weak quarters in the not too distant future.
When you're thinking about equity markets from here in this sort of context, you're expecting the S&P 500 to climb from here through the end of the year?
Yeah, well, we have a 12-month target, or June next year, of 4,700 on the S&P. So, this recent correction has kind of brought back a lot of value into the market. Another interesting aspect of it is if you look at the broad market and the overall multiple on a weighted basis, it looks expensive. But if you look at it on an unweighted basis, actually the market is obviously it's more expensive than it is in Canada. But it's not a stretch to it's probably trading around 16 times earnings on a unweighted basis. So there's some pockets of value in the market, and I think investors are kind of poking away at that right now.
And what are you thinking for the TSX? Because it does seem like today's gains are very much driven by the energy sector, although almost all sectors were trading higher this afternoon on the TSX. But seeing it cross over, maybe we can show the year to date, but to get back into positive territory for the year, because the TSX had fallen into negative territory year to date. So now it's up 0.6%. Do you think that the TSX will continue to climb out of that sort of hole that, it fell into just a few days ago?
Well, like everything else, it all depends. It's, to a certain extent, energy has been driving this market recently, and we've had a correction in gold prices. There was some pickup in gold prices recently because of the events in the Middle East. The banks, they were undervalued to a large extent as well. I think the drop in interest rates, I think that has more to do with what's happening in the market than anything else. Quite honestly, everything else appears to be mostly noise, because at one point we were playing around with a 5% 10-year Treasury. Today we're back down to 4.65. Treasury yields are down as well, and I think that's what's pushing the markets higher. There's kind of this fear that the bond market knows something maybe that the equity market doesn't know. And, this was pushing up mortgage rates, and obviously it's kind of compounding the problem as far as the consumer is concerned. So I think that's driving the market. The other thing is some of the defensive sectors in the market, like the telecoms, what we used to call the pipelines, which are now infrastructure stocks, and the utilities in general have been a very weak part of the market. Particularly you look in the third quarter, those are the weakest parts of the market. And the reason for that is they're bond proxies. And as interest rates have gone up, these stocks have corrected quite substantially. Now you put that in reverse, and all of a sudden these stocks start to look quite attractive in a declining rate environment, especially when the Fed is talking about maybe they're done. So that could be, there are all sorts of parts in the market that are kind of headed in the right direction here. Energy prices have corrected. It's mostly because of gasoline prices in the U.S., for example. So it's a product market that's wagging the crude market. Yeah.
I wonder what you're thinking about the consumer. We were watching Amazon stock today, but also just Amazon in general because it's got its Prime Day sales going on, trying to get a sense of maybe how well that'll do for Amazon, but also just to get a sense of the consumer. Are they willing to spend right now? And it seems like the initial data, not from Amazon, but from a firm that tracks credit card payments or credit card transactions, rather, suggested that people are spending, but on smaller items, not on those sort of big ticket items, which probably isn't a surprise. But how are you reading into the strength of the consumer these days?
Well, to a certain extent, it's all the pandemic savings that are that whole thing is being wound down quite significantly. I think in the U.S. I saw some stats to the effect that it's only the top 20% of income earners that still have some leftover savings from the pandemic, which means that 80% of consumers basically run out of savings, and their savings rate is extremely low. So I think the consumer is living on borrowed time. I think the top 20% earners will probably continue to consume, and they account for about 40% of consumption anyway. So it's not the end of the world, but I think a lot of people are stressed right now, and the number of Americans and Canadian consumers, for that matter, that are living paycheck to paycheck just keeps increasing as well. So I think that's part and parcel of the worry about the consumer in general. I think is valid, and as we head out into the fourth quarter next year, I think that'll be the main concern for the economy going forward.